The best way to get tax-free income. In this episode, we are going to address the question, can you 1035 exchange from annuity to life insurance? Get ready to learn the do's and the don'ts, what you can and can't do, because you must do 1035 exchanges to like instruments. So what is a like instrument? And you want to make sure you improve the tax scenario, not make it worse. So my name's Doug Andrew. I've been a financial strategist for north of 46 years and helping many people optimize their assets, minimize taxes, and empower their authentic wealth, but especially from a financial standpoint, help them not outlive their money in retirement. One of my favorite vehicles for providing the most predictable tax-free cash flow or income at between 7 to 10% payouts. What does that mean? That every $1 million that you accumulate can generate 70, 80, 90, usually up to $100,000 a year of tax-free income for as long as you live. If you retire at age 65, it would keep going if you live to be 120. It's what I affectionately call the laser fund, which is an indexed universal life insurance contract that is maximum funded under IRS guidelines. So many times people will come to my educational events and they'll say, is this an annuity? No. An annuity, simply put, is a savings account with an insurance company. Many different pension plans use annuities with insurance companies because the multi-trillion-dollar legal reserve insurance industry is not only the backbone of America, but the backbone of the world. It's oftentimes where governments go to for help. One of the insurance companies where I put a lot of my money manages $3 trillion. That's as much as the IRS collects in income taxes in an entire year. One insurance company, okay? So they've come through the Great Depression with flying colors. There's not one single legal reserve insurance company that went under in the Great Depression. In 2008, when 400 banks went under and 900 more were on the brink, the watch list. During that time, there was not one single legal reserve insurance company that went under. If during a critical time period, they go temporarily insolvent because of a run on the bank, they still honor all of their claims because the insurance industry cross-insures each other. So many people choose to put money into an insurance company because of the safety, okay? It's the last industry that would go if the entire American economy went to heck in a handbasket. You would have so much warning, the banks would be failing, real estate would drop 80% like the Great Depression, and you would have plenty of time to get your money out. But think about it, if it's that bad and you got your money, where would you put it? See, the American dollar would be worthless, so it wouldn't matter if you had your money if it got that bad. So I put my money in the last thing that would go before I would be forced to just live on the carrots I grew in my backyard. Now, with an insurance company, there are two general products offered by most insurance companies that help people accumulate their money for retirement and so forth. One is an annuity. Annuities accumulate your money tax deferred, not tax-free. It's sort of like an IRA or 401k. You don't even have to have an annuity that's an IRA or 401k. You could fund it with after-tax dollars, but it's only tax deferred. If you put $500,000 into an annuity, and let's say it's earning 10%, which most are not earning, but let's say you had one that did, 10% on $500,000 would be $50,000 a year of income. That would be 100% taxable income because the last money you're earning, the interest, is the first money coming out. That's what LIFO means, last in, first out. That's why I've never owned an annuity. I doubt I ever will. Why would I own an annuity when I can earn a higher rate of return in a maximum funded insurance contract? And people say, what? Well, an insurance policy, you're paying for life insurance. They're more expensive. Not if you structure it correctly. They actually outperform annuities. So when people learn this, they realize that the insurance policy, if it's maximum funded, it accumulates your money not just tax deferred, it can be totally tax free. So that when you put money in there, and if it's earning 7 to 10% a year average, like I've averaged, your money will double every 7 to 10 years, because 7.2%, your money doubles every 10 years. If you're earning 10%, it doubles every 7.2 years. And when I finally have a nest egg, let's say of $1 million, the life insurance, if it's indexed universal life, I have averaged a little over 11% for the last 26, 27 years, netting 10% after the cost of the insurance. So it's actually pretty inexpensive. I earn 11 and net 10, but that 10% is tax-free. Meaning $1 million nest egg can generate $100,000 a year of tax-free income, where an annuity may only give you maybe 5 or 6% payout. If they gave you a 10% payout, it's not tax-free. So the first question I get asked is, well, can you exchange an annuity for life insurance under Section 1035 of the Internal Revenue Code? The answer is next. So the short answer is no, because they are not like instruments. One is an annuity, which is like a savings account with an insurance company where your money accumulates tax deferred, and when you take it out, it's now taxable LIFO. Life insurance does not do that. Life insurance is totally tax-free as it grows, and when you take it out, if you do it the smart way, it's totally tax-free. So you cannot do a 1035 exchange from an annuity to life insurance, nor would you want to. Now, what's interesting, you can do the opposite, but I would never do that. You could exchange a life insurance policy for an annuity, and you can do what is called a 1035 exchange. Now, Section 1035 of the Internal Revenue Code simply says that you can exchange one financial instrument from an insurance company, okay, if it's life insurance, for a like instrument, another life insurance policy. You could go from whole life to universal life. You could go from variable whole life to variable universal life, or index universal life, or whatever. But those are all life insurance policies. You cannot take money out of an annuity and put it into life insurance, because you're going from tax deferred into tax free, and the IRS will not let you do that. But they'll let you do the opposite. If you're dumb enough to take money that is tax free out of an insurance policy and do a 1035 into an annuity, you're going to trigger a tax consequence instantly, because now you're going over to an annuity and you have to pay tax on the gain that you had over and above your basis in the insurance policy that was tax-free, and you just buggered that up. So that would be a stupid thing to do, but the IRS will let you do that one, but they will not let you go from tax deferred to tax-free in an insurance contract. So what is the best way to get the money out of an annuity and over to a better instrument like a maximum funded tax-free insurance contract? So you do not want to move money directly from an annuity, even if they let you to go into the insurance contract, because you would ruin the tax-free nature of the insurance, because it did not come from a like investment. So the better thing to do, and we've had many, many people who would come to us with an annuity and they were dissatisfied. Now, you always use caution if you're going to do any kind of an exchange. You want to analyze with an in-force illustration, what is this annuity likely going to do in the future? And an insurance company will give you an in-force illustration showing, based on current interest rates and so forth, what it will likely provide. But you really ought to ask yourself, why did you take out the annuity in the first place? If it was to grow your money safely at a nominal rate of return and then have taxable income, has that objective changed? Most of the time people say, well, yeah, when I learned that a maximum funded insurance contract can outperform an annuity and it's tax-free, I get a higher rate of return, it's tax-free, and when I ultimately die, if I have $1 million in there, it blossoms to $2 million when I die. An annuity doesn't do that. Yep. And so a properly structured maximum funded insurance policy can knock the socks off of an annuity. But what you do is you simply look at the annuity and make sure that you're not going to be clobbered with surrender charges if it's in the early years of the annuity. Now, you don't want to wait till all surrender charges are waived, because in an annuity, they usually go down, down, down. The longer you've had them, the more years that you've owned it. But at a certain point in time, you will make up for the surrender charge. At that point, you take the money out of the annuity. Even if there's a small surrender charge, you take that money and then you fund the insurance contract in accordance with TEFRA, DEFRA, and TAMRA guidelines. Those are tax citations that make sure your money not only grows tax-free, but allows you to take it out tax-free down the road. I have other episodes that talk about TEFRA, DEFRA, and TAMRA. If you type in those questions, you'll see those YouTube educational videos about those tax citations. You take the money out of the annuity when it's the proper time. You get it strategically put into the insurance contract, and now you've improved your situation. If it's structured right, you will now accumulate your money not just tax deferred, it will be totally tax free. But most importantly, you'll have a higher rate of return if you use indexed universal life, whereas an indexed annuity generally does not have as high a rate of returns as indexed universal life. The best indexed annuities usually illustrate between maybe 6, 7, 8% at the best. My universal life insurance contracts have performed at 10, 11, and some years as high as 25%, with multipliers as high as 55%. You don't have indexed annuities that do that. And so you want to preserve the tax-free access. When you take money out of an annuity, you want to improve your situation for a different goal. You want the highest net spendable income, and you want to grandfather yourself under the TAMRA tax citation to generate on $1 million, $100,000 a year of tax-free income without depleting principal, which will knock the socks off of $1 million in a traditional annuity, even an indexed annuity, even with the same insurance company. And a lot of people, even insurance agents, do not understand that. So many times in my career, people have said, wow, that sounds too good to be true. How can I learn about this? This is what motivated me to write my very first book, which became a bestseller, and then several other best-selling books. One became a New York Times, Wall Street Journal #1 bestseller. But my 11th book is titled The Laser Fund. And it's actually 2 books in one. This side is 200 pages, 14 chapters with all kinds of charts and graphs of how the Laser Fund, which is a max-funded indexed universal life insurance contract. The Laser Fund means liquid asset safely earning returns. That spells the acronym LASER. And so this is how to diversify and create the foundation for a tax-free retirement, where annuities don't do that. If you learn by stories, you flip the book over, and this side has 12 chapters with 62 actual client stories. I would love to gift you free a copy of this book. I'll show you how you can get it. If you go to laserfund.com, you simply pay $5.95 shipping and handling. I'll pay for the book. You pay for the shipping. I'll fire one out to you. You'll also have options if you like to listen and learn or watch and learn with audio and video formats also.